Welcome to the Deep Dive. Today we're jumping straight into Godrej Consumer Products Limited GCPL. We'll be looking closely at their Q1 FY26 performance, trying to understand what's really going on under the hood. We want to give you a clear picture of their recent results, the challenges, the opportunities, and what it might mean going forward. Okay, so let's unpack this. Before we dive into the latest numbers, who exactly is Godrej Consumer Product Limited, GCPL? What's their core mission?
Well, at its heart, GCPL is really focused on bringing health and beauty products to consumers, especially in emerging markets, those dynamic economies.
Yeah.
And their guiding philosophies are quite revealing. Things
Yeah.
like consumer first, business second,
Right.
which really emphasizes sort of local thinking, but with global execution. They also prioritize tomorrow before today, so always looking ahead for future growth. And there's this commitment to balancing people and planet alongside profit.
Interesting balance. And I understand they have a pretty specific strategic approach to actually achieving growth. How does that work?
Yeah, they do. They basically lead through what they call category development, essentially expanding the market for their kinds of products. And they fund that growth by simplifying operations, cutting costs where they can. How they measure success is interesting, too. They aim for industry-beating underlying volume growth, UVG.
UVG. Got it.
Exactly. Plus, they're always trying to boost brand investments while at the same time cutting the cost of service. They focus on boosting automation to reduce working capital and fostering diversity alongside environmental impact. I mean, they're a big player. Market cap is around, 1,025,000 crore rupees. And importantly, they did see competitive volume growth in the June quarter, especially from the non-soap part of their domestic business and the Africa business. That's a pretty solid base.
That sets the stage perfectly. So how did all these strategies, this philosophy, translate into actual performance in Q1 FY26? Because looking at the headline numbers, it seems like there's a really fascinating story there straight away.
Oh, definitely. So if we look at revenue, consolidated net sales saw pretty healthy growth, up 10% year on year. In constant currency terms, that was even a bit better, 11%. And standalone net sales, just looking at India, that increased by a significant 8% year on year.
Okay, solid top line.
Right. And when we look at that underlying volume growth, the UVG consolidated was a robust 8%. Standalone UVG was 5%. So decent volume movement. Now, profitability. Oh, that's where the picture changes a bit. Consolidated EBITDA, that's earnings before interest, taxes, depreciation, and amortization, actually declined by 3%.
Declined, okay.
Yeah. And the margin was 19.2%. That's down from almost 22% the year before. Standalone EBITDA also declined, down 6%, with its margin dropping too. And management has been pretty upfront about this. They've indicated these margins were clearly hit by ongoing cost headwinds, mostly input costs rising.
Right, those input costs can really bite.
Exactly. And then finally, net profit. Consolidated net profit, basically flat, 0% growth. Standalone net profit actually declined by 4%.
So, if I'm getting this right, really strong growth on the sales front, undeniable. But there's this noticeable pressure on profitability. That seems to be the main tension here. So the big question is, where are they seeing success geographically and where are the challenges really concentrated when we break down the business?
Yeah, and what's really fascinating is just how varied the results were across different regions, and even within India, how different product categories performed. So starting globally, India actually reported strong net sales, up 8% year on year, solid domestic performance. Now, Indonesia, on the other hand, saw its net sales decline by 4%. It seems like that market faced some pretty tough macroeconomic headwinds, plus really intense competition on pricing. And that resulted in basically flat underlying volume growth there.
Tough environment.
Very. But interestingly, even with those broad challenges, hair color and baby care within Indonesia actually delivered strong double-digit growth.
Yeah.
And they gained market share. So some bright spots even there.
Okay. What about other regions?
Well, Africa, USA, and the Middle East, that region was a real powerhouse this quarter. Really robust performance. Net sales up a significant 30% year on year.
30%. Wow.
Yeah, huge. And that was apparently fueled by new product launches in hair fashion. And they successfully introduced these air pocket air fresheners in key markets like Nigeria and South Africa. Their hair care range there also delivered very strong double-digit growth. And then Latin America and others also showed impressive expansion. Net sales up 18% year on year. And maybe even more notably, their EBITDA in LATAM grew by an astounding 102%. So really strong operational leverage kicking in there.
Okay, so a very mixed picture internationally. What about within India, breaking down those categories?
Right, let's look at the standalone India business categories. Home care was a massive driver, huge. Sales growth of 16% year on year.
16%, that's strong.
It really is. And within that, Household insecticides showed solid performance. You had double-digit growth in the premium electricals. Their incense sticks grew about 2.5 times. The non-mosquito portfolio also saw strong UVG gain market share too. Air fresheners were consistent. Strong double-digit growth across different formats. Aero scaled up significantly. Air spray saw excellent growth. They even launched a new air plug. They're maintaining market leadership there. And fabric care kept up its solid run. Strong double-digit UVG for the 6th quarter in a row, gaining market share with their Fab brand. So home care was really firing on all cylinders.
Sounds like it. But what about personal care? You mentioned the overall standalone growth was only 8%, so personal care must have been softer.
Exactly. Personal care tells a different story. Sales grew a much more modest 1% year-on-year. Personal wash, specifically soaps and washes, had a pretty subdued performance. Revenue was largely flat. That was due to competitive pricing pressures and also some adjustments they made in trade margins and maybe some grammage reduction. And management actually anticipates this margin pressure will likely continue into Q2 for this segment.
Okay, so pressure continuing there.
Yeah, but on a brighter note within personal care, hair color delivered strong double-digit performance, impressive UVG, and they maintained positive market share. And perfumes and deodorants grew at a healthy mid-teens rate. That was supported by popular new lines like Amazon Wood's 4X and the Block Antiperspirant, both apparently showing good repeat purchase rates.
That's a lot of detail, but it really does paint a clearer picture. Strong performance here, challenges there, both internationally and within India. So what's management's take on all these numbers? And critically, what are they actually doing about the challenges, particularly the margin pressure?
That's a vital point, their proactive approach. Management has stated, that the strong revenue growth was driven by that robust underlying volume growth. Pricing increases met their expectations. However, they fully acknowledged, as we discussed, that EBITDA margins were negatively impacted by those ongoing cost headwinds. That explains the pressure we saw.
Right.
Specifically for personal wash, they do anticipate continued margin pressure in Q2, the next quarter. But importantly, they project to return to more normalized margins in the second half of this fiscal year.
And why is that? What gives them that confidence?
It's largely due to an expected moderation in palm oil prices. Palm oil is a massive input cost for soaps and washes. So if those prices ease off, as they expect, that should provide significant relief. It's actually fascinating how a global giant like Godrej is still so directly exposed to the swings in a single commodity like palm oil.
It really highlights those dependencies. What about cost savings? Are they managing to find efficiencies elsewhere?
Yes, absolutely. And this is a positive point. GCPL's cost efficiency initiatives seem to have really paid off this quarter. They successfully generated 150 to 200 basis points of savings in advertising and publicity spend. That's like 1.5% to 2%. Pretty significant and exactly as they planned.
How did they achieve that?
It sounds like it was through a mix of things. Strategic use of automated in-house tools for media buying, scaling up their overall media buys for better rates, doing more direct digital buying, and even collaborating with new agencies to optimize spend. It shows a very focused effort on efficiency.
So it's clear they're not just, sitting back and letting these challenges happen. They're actively pulling levers to improve efficiency. Can we dive a bit deeper into that volume story you mentioned earlier? Because there were some interesting details there, especially about the non-soap portfolio.
Absolutely. It's a key part of the narrative. So India's overall volume growth, that 5%, was really supported by diversification and quite aggressive innovation, particularly in that strong home care business. Brands like Goodnight and Fab really led the charge there. However, as we touched on, the personal wash segment, especially soaps, definitely saw subdued volume growth. And that sustained margin pressure was almost entirely because of that persistent palm oil inflation.
The palm oil effect again.
Exactly. But here's the crucial bit. If you actually exclude the soap portfolio from the India numbers, volume growth in Q1 was actually in the mid-teens.
Mid-teens, that's a huge difference.
It really is. It highlights that many other parts of their Indian business are performing extremely well on the volume front. Just to give a trend, looking back year on year, Q1 FY25 volume growth was 10%, then slowed 7% in Q2, went flat, 0% in Q3, then rebounded to 5% in Q4 FY25, and now it's held at 5% in Q1 FY26.
Okay, so holding steady recently after some volatility.
Right. And within that, household insecticide growth actually accelerated. That was driven by the premium end, like electricals, and scaling up these newer, more advanced liquid vaporizers. And they gained market share in HI, which is impressive given weather issues and that ongoing competition from illegal incense sticks. In personal care, hair care gained market share, which is definitely a positive. But the soap portfolio, as we said, saw degrowth, partly blamed on a weak summer, but also that move to reduce pack sizes to offset high input costs likely played a role. They do expect better performance for soap in the second half of FY26, banking on those easing palm oil prices.
And international, just a quick recap on the volume side there.
Sure. Indonesia, as mentioned, faced a tough quarter. Weak macro conditions, competitive headwinds really impacted volumes there, but the Africa cluster continued its robust growth trajectory. Although higher on-ground activities, maybe promotions or launches, did lead to some margin compression in Africa. But that's also expected to improve going forward. So the overall outlook seems, cautiously positive. Easing palm oil prices, those cost-saving initiatives kicking in, and improvements expected in the international business, all these factors are expected to drive solid, double-digit EBITDA growth for the full fiscal year, FY26.
This really highlights those underlying dynamics, doesn't it? While there are these broad challenges like commodity prices, specific product innovations, and strategic shifts in areas like home care are making a real difference. So thinking about the road ahead then, what are the projections actually looking like for GCPL? What's the outlook?
Well, the expectation is that the home care segment's volume growth should improve further in the coming quarters. That's backed by product differentiation and their rising market share, especially in fabric care. There's also anticipated sustained growth in household insecticides. Think about that continued consumer upgrade from basic incense sticks to electricals. And also in fabric care, the shift from powder to liquid formats. Those are ongoing trends.
Right, premiumization trends.
Exactly. And even for the soap category, which is highly penetrated, volume growth is projected to gradually improve, maybe back towards its long-term range of, say, 2–3% annually. Demand is pretty inelastic, and the population keeps growing. And they're looking at new growth drivers, too. Things like deepening their reach in rural areas and expanding into niche segments. They mentioned pet care, for example, which could open up entirely new avenues.
Interesting. So what does that translate to in terms of overall financial projections?
The company seems to be on track to achieve high single-digit consolidated top-line growth for the full fiscal year. That's driven by mid to high single-digit volume growth here in the domestic market. If we look at some specific consolidated financial projections out to fiscal year 27, sales are projected to grow steadily. From about 14,000 crore rupees in FY24, the aim is over 15,500 crore in FY26, and then breaking 17,000 crore by FY27.
Okay, steady growth trajectory.
Yeah. And similarly, net profit is expected to climb from roughly 9,100 crore in FY24 to over 2,100 crore in FY26, and potentially over 2,400 crore by FY27. Their EBITDA margin is projected to recover as well, hitting maybe 21% in FY26 and 22% in FY27. And interestingly, the PE ratio, the price-to-earnings multiple, which measures valuation, is actually expected to trend downwards, from around 65 in FY24 to maybe 59 in FY26 and 52 in FY27. That suggests the market expects earnings to grow faster than the share price, potentially making it look more attractive over time.
So the company clearly has a plan, a vision for continued growth and getting profitability back on track. But, as always, no path is completely smooth. What are the potential bumps in the road? The key risks that could derail these positive projections?
That's a really important question, right? What are the potential headwinds? First, you've got those macroeconomic headwinds and just intense competition. We saw that very clearly playing out in Indonesia this quarter, where it led to declines in both sales and EBITDA. It just shows how external market conditions can really bite, even for a large player.
A real-world example right there.
Exactly. Second, commodity price volatility remains a significant risk. We've talked a lot about palm oil's impact on personal wash. While they anticipate moderation, it's still a major variable for their input costs, not just for soap, but across other products too. And beyond specific commodities, there are just broader cost headwinds. General inflationary pressures, rising operational expenses, these could continue to challenge overall EBITDA margins across the board.
And what about operating internationally? Any specific risks there?
Yes, currency fluctuations are a factor. When you operate in high inflation economies, like Argentina, for example, you're exposed to significant currency risks. In fact, the application of hyperinflationary accounting standards actually led to a direct negative impact on their reported revenue and profit in Q1 FY26 because of the situation in Argentina. So that's another external factor to watch.
It's definitely crucial to keep these potential challenges front of mind. They can significantly shape whether those positive projections actually materialize. So, bringing it all together then, what's the big picture takeaway for you regarding GCPL's Q1 FY26 performance?
I think the Q1 performance for Godrej Consumer Products paints a mixed picture, but ultimately I'd say a resilient one. You've got undeniably strong top-line growth, revenue increases around 10% consolidated, driven by that robust underlying volume growth, especially internationally. However, profitability definitely faced challenges. EBITDA declined, mostly because of those external cost headwinds hitting margins hard.
Right. Growth versus profit.
It's exactly. Geographically, the Africa, USA, and Middle East segment was a real star performer, driving growth. Indonesia struggled. Within India, home care was exceptional, really strong. But personal care faced those headwinds from commodity prices and competition. On the positive side, though, the company showed effective cost management. Those A&P savings were significant, and they maintained a stable debt-to-asset ratio, which is good financial housekeeping.
So, what's the key message for someone trying to understand GCPL right now?
I think for you, the key takeaway is this. Despite healthy volume and revenue growth, GCPL is currently navigating a tricky period of margin compression. It's mostly driven by external cost factors, like palm oil. Now, management anticipates some margin recovery in the second half of the year, especially for personal wash if palm oil prices cooperate. But the crucial thing to watch will be their ability to sustain that volume growth while also expanding margins. Doing both simultaneously in what's still a very competitive and volatile environment, that's the challenge.
And what about valuation?
Yeah, the stock's currently trading at about 52 times its estimated FY27 earnings. That is above its historical 5-year average PE, so it's not cheap by historical standards. That said, there's a belief that the benefits of potentially lower palm oil prices, plus their recent innovations, are just a fundamentally strong business mix. These factors are expected to drive sustained earnings growth going forward. We remain pretty positive on their strong execution, both domestically and internationally, and especially their strategic focus on these underpenetrated premium categories. That's where future growth often lies. So the advice would be to closely monitor those commodity price trends, especially palm oil, and also keep an eye on the performance of key international markets like Africa and Indonesia in the upcoming quarters. That will give you the signs of whether that sustained financial improvement is truly taking hold.
That's a truly comprehensive look. It really gives you a lot to think about how a company like GCPL has to navigate these powerful cross currents of strong growth opportunities on one hand and significant cost pressures on the other. What really stands out to you about how they're managing that tightrope walk between boosting sales and protecting the bottom line? Well, that's all the time we have for this deep dive into Godrej Consumer Products Limited. We certainly hope this has given you some valuable insights and helped you connect the dots on their recent performance and outlook.
And before we wrap up, just a necessary reminder, we are not SEBI-registered financial advisors. This discussion is for informational purposes only. If you are considering making any investment decisions based on this or any other information, please consult with a certified financial advisor first.